Hi, everyone, and welcome to Strategic Wealth Strategies with our host, Alan Porter. Alan, what's going on? You and I were talking about some next podcasts because, what happens, we've planned out so many topics so far. It almost will be 6 months to the podcast. And there's some other things because financial planning is a challenge. It's not easy. And so many people fail at it. And it's probably one of the biggest wealth generators for financial institutions is financial planning, right? Is that
Exactly right.
they make so much money, right? On people's money.
The thing is, everybody needs a financial planner because they're the experts, they're the specialists in the field. But there's a big difference between some financial planners and myself. And I'm probably different than 99% out there because of my beliefs of what I do and the passion that I have for what I do. And I teach people to think outside the box of conventional financial planning of the 60-40 stock portfolio that's been ingrained in our brains for years and years and years. But I'm much different than that.
Absolutely. All right. So I want to go into 60-40 is another topic, but here today, Alan, people hear about Dave Ramsey. We talked about this in his Debt Free for Life program and his disdain for cash value life insurance. He disdains it. And he believes in the term life because I read the book too. And, when I was 20 years ago, I said, nope, I'm going straight term. I'm not thinking of this because I'm not going to get a good rate. And maybe 20 years ago was different. What do you have to say about that?
Well, first off, let me say that Dave Ramsey, I agree with about 50% of what he says. But he deals with a vast majority of people that make less than, I guess, $50,000. Now, I applaud Dave for what he's done. He teaches people how to get out of debt using the snowball method. But the other things he says, like buy term and invest the difference for retirement, that's the worst advice I've ever heard. And I've got points to prove it. And I was watching one of David McKnight's. He's the author of The Power of the Zero and Look Before You Leap and some other things. And David is a fantastic mind when it comes to financial matters, especially when it comes to tax-free matters. And so I watched that, and David just destroyed him. And I feel the same way David does. When you watch this, and anybody wants to, just contact me, and I'll give you the link for David Ramsey's podcast that says cash value life insurance is crap, or universal life insurance is crap. And first off, he's got his announcer that works for him, and they're telling about all the fees and everything. And first off, it's full of half truths and outright falsehoods. And I prove every point he says wrong, and so does David McKnight.
Yeah, and you were talking about.
But he's sponsored by all the major networks. I just saw him on Fox the other day, and I'm going to write Fox. I want to get on that show because I want to let people know what's really available out there, what's true about there. David says buy term and invest the difference. Dave Ramsey says buy term and invest the difference. But come to find out that he's involved with a term insurance program. I don't know if he even has his license. I don't know if he's a fiduciary. Now, I'm a certified financial fiduciary. I've taken the extra courses, done all the proper training. I'm a registered investment advisor. But my biggest thing, both professionally and personally, is protection of clients' family and protection of their assets. And when I see some of these things, like what Dave Ramsey puts out, Susie Orman, it burns my butt because it's not the truth. It's half truths. But like I said, it's great for certain people, but for the other large portion of people, it will destroy their retirement. Here's the big problem. If you've got, if you said, buy term and invest the difference. Well, let me tell you something. Probably 99% of the people will buy term.
Right.
And at least 1% will invest the difference. Well, the other people, the problem is 99% will buy term, but then they'll go out and blow the money. But that 1% that invests the difference, they have no idea what they're investing in. And they'll put their money in a 401k or something else. Well, I've done podcasts before with you that shows the dangers of the 401k. Even the father of the 401k, Ted Beeman, said the 401k is a disaster and it needs to be replaced. because it's full of risk. Think about people right now, Neil, going into retirement, and they just lost 20% in the market, and they're getting their money from a stock portfolio. It's called sequence of returns risk. If they don't have another bucket of money to which to withdraw that money from instead of their stock portfolio, they're going to be out of money in probably 7 to 8 years, because they're taking money in the first 3 years of a down market as compared to the last 3 years, just in a 10-year period. But if they do that with just a stock portfolio, their retirement is going to be decimated, and they don't know about this. Their financial planners don't tell them about sequence returns risk. They don't tell them about longevity risk, which is a risk multiplier. And here's something I tell people: listen, I can protect you. There's 18 risks in retirement. I can protect you from almost every one of them. I can call them out. But here's the number one fear in retirement: is running out of money before you run out of life.
Totally.
And I can protect you from that.
All right, Alan, what do you mean cash for life insurance is too expensive?
Well, I got a short PowerPoint. Let me just bring this up real quick, okay?
Okay. I'm going to give you the ability, as we're talking again to Alan Porter, Strategic Wealth Strategies. Really great information so far, as we're about to see this PowerPoint. This information is unavailable anywhere. That's why I'm excited about learning from this stuff, because guess what? It's not being taught. It's not being taught, and any financial planner is going to focus on where they can make their most money, and that is just like a salesperson selling a car. If they can get the best price if they can make the most off the commission, they don't care if they're saving their customer the money. They want to make the most money, and it looks like that's what a lot of financial planners do.
That's exactly right. They're paid a fee whether you make money or not.
Mm-hmm.
Now, listen, I can do that, but I don't. I used to, but I have a team of people, Neil, that I work with, tax-specific CPAs and tax-specific attorneys, top specialists in their fields, and we collaborate together to bring you, we provide solutions for people's financial problems. If you want to do a stock portfolio, I have a team of people that will do that for you.
Right.
But what I want to do is give you a well-rounded, I don't want to replace anybody's advisor. I want to work with them as a team to give you, the client, the best possible scenario. And I've had people tell me, well, my advisors handle all my tax and financial information or decisions. I said, you may have the best advisors in the world, but it's what they don't know that may end up costing you hundreds of thousands, if not millions of dollars, in undue taxes, fees, and lost opportunity costs. And a lot of people ask me, what do you mean by lost opportunity costs? I said, well, let me ask you this question. How would you like to have a tax-free retirement program that's paid for by the government? Well, what do you mean? I said, well, that's a lost opportunity cost that I know how to do. And, the conversation goes on from there. But the question you asked me is something about expenses.
Yeah.
Dave Ramsey and his compadre that was interviewing said, oh, the expenses are so high, this, and this. I don't know why anyone would ever do this. Well, let me show you something. First, the cost of insurance is front loaded. Mm-hmm. Over the life of the policy, your expenses decrease because when you get closer to the death benefit with the cash value in your policy, the cost of insurance goes down. You can use cash value life insurance, the death benefit, as long-term care for terminal illness. And also you can use 90% as tax-free. Mm-hmm. But if you have this policy, and this is not a short-term product, it's like a 401k, okay? Don't expect to get returns on this after 5 years or something like that. Mm-mm. This is like a 401k. The longer you use it, the more it grows. And guess what? You're never going to have a loss due to a market downturn, and that's guaranteed by contract. Right. We use indexing strategies to grow the cash value. But here's the thing. Total cost of the life insurance policy is front loaded. Yes, I agree with everybody. It's expensive, but those expenses go down. And by the time you've been in that policy for 15, 20, 30 years, those policy charges anywhere from 0.5% to 1%. Now, let me ask you this question. Those expenses are expenses compared to what? Too expensive compared to what? A financial planner's fees and the taxes you have to pay. Now, I've done hundreds, if not thousands, of these illustrations, and I can show by computer-generated software that the fees and expenses of a 401k plan or any stock portfolio are going to be more than cash value life insurance anywhere from the 4th to 15th year. Because if you're paid a fee, you first off, you make money whether the client is making money or not. And then there's taxes. Good God, we have 52 different types of taxes.
Right.
We had a congressional budget report a couple months ago that says if you, because of our tremendous debt, we have $31 trillion in debt. By the year 2030, if we don't raise our taxes by 66 or 60 or 66%, we're not even going to be able to pay the interest on the loan.
Right.
That
And
can't
they said the
happen
market's
because
going down on the 2024, so it's gonna be a very bad year in 2024. Already, they're already predicting this. So it's like you better just figure out a better way of saving long term. How much can you make every, like, what is the average return for cash value life insurance?
Well, Neil, here's the thing. It's especially in retirement, it's not about average rate of return, it's about distribution of assets. But here's the thing. Cash value life insurance companies have made anywhere from 6 to probably 8.5% or more every year for hundreds of years. And one thing, I work with mutual companies, which means they look out for the policyholders and not a stockholder. And a lot of these insurance companies are being bought up by equity companies. And one thing I teach people is about the TSR ratio, the transparency solvency ratio. And when I show them that, they're going, "Oh my God, my financial planner has never told me about this before."
Mm-hmm.
Because they don't know.
Okay.
And these reports are done by Tom Gilbert. He's a financial examiner with the federal government. He investigates bank fraud. Okay. But when I show people this, it's amazing. But that's for another time. But here's the thing. Let me ask you this. What financial product does the following? And I got 3 slides for this.
Okay.
It's tax deductible in certain cases. If I set that policy up right with the proper people, business owners, doctors, whatever, it can be tax deductible. It grows tax deferred. Now, your 401k grows tax deferred. And I ask people, why do they go and put their money in a 401k? They said, well, it's a tax deduction. I said, no, when you put it in a 401k, it's tax compounded. I said, what do you think the government wants you to do? Pay taxes on the seed, which you put in your 401k, or the harvest, and the larger portion. But the problem with that, when they pay on the harvest, you don't know what interest rate they're going to charge you in your taxes.
Right.
It's tax-free distributions. I have people tell me that, of course, the Roth products are tax-free, but I also have them tell me that a municipal bond or educational bond is tax-free. I said, I beg to differ, because if you live in a state other than where those bonds are issued, you have state tax to pay. You have estate taxes to pay if your state's large enough. Does not affect taxation of Social Security or the means testing Medicare Part B. Now, Neil, this is absolutely huge, because up till 1993, there were no taxes taken out of Social Security. But Social Security has it's a numbers problem. I think it was enacted in 35, first paid out in 42. You could take Social Security when you're 65, but life expectancy was 62. Now you can take it out at 62. Life expectancy for a man is 85, 87 for a woman. And if you're married at age 65, it's even longer.
Mm-hmm.
But here's the thing. Let's say that you have make $44,000 outside provisional income, such as the 401k, stock portfolio, rental income, real estate, whatever. And you're married age 65, and you make $3,000 a month Social Security. What that does right now, it puts you in the 12% minimum tax bracket, but we have a progressive tax system. So your effective tax rate, I think, is about 10.13 or 16, something like that. Provided taxes don't go up, you can pay taxes of over $6,000 a year every year for the rest of your life. And I ask people, I said, what do you think taxes are going to go up or down? If you say they're going down, I got mountain land in Florida to sell you, because taxes only have one weighting, and that's they've got to go up. We're in the lowest tax bracket we've been in 70 years. Mm-hmm. And here's something else people don't understand. Because of the Jobs Act that President Trump put in and got new tax standards, it changed what Obama had in 2017. January 1st, 2026, those tax brackets are going back to what they were in 2017. And some of the people in the 12% minimum tax bracket right now are going to a 25% tax bracket. Now, Neil, that's 100% higher. Now, not all tax brackets are going up that much, but they're all going to increase. But the big date we got to watch out for is 2030. But here's another thing: people don't understand. They have no idea about the means test in Medicare Part B.
Right.
And I'm retired military. I thought my retirement my medical care would be paid for through the military.
Mm-hmm.
Well, little did I find out, because of the adjusted gross income, which affects the means test in Medicare Part B, I've got to pay $6,000 a year for Medicare Part B. I never thought I'd have to pay that. That's a lot of money.
Yeah,
That's just for myself. That's not my wife.
That's crazy.
But I mean, people, they don't even know about this stuff. And their financial planner doesn't tell them. Their CPA doesn't tell them. It's a matter of education, like I said. But here's the big thing: tax-free distributions. As I said before, what's more expensive, the expenses in a life insurance policy, a cash value life insurance policy, or your fees and taxes? I can show you of software I've got, because I deal in scientific, mathematical, and economic facts that are taught to me by the PhDs in retirement. They don't sell for a company. They don't sell a product, but they know the education. They know how to have a optimal retirement. But these are facts, not opinions of some financial planner. Now, I have my opinion, but I agree with these PhDs. But tax-free distributions, cash value life insurance, and your Roth products are the only ones that I know that have complete tax-free distributions.
Okay.
But here's the thing: think about this. What if they raise taxes for people in a 10% tax bracket to 20%? That's a
doubles.
Increase.
Everything doubles, 100% up.
Yeah. I mean, it's crazy. But see, that people don't understand that taxes. It's not how much money you have in retirement; it's how much money you can take home after taxes.
Income versus assets after retirement.
Well, one of the things I do, Neil, I said, I can show you can run out of assets, but you'll never run out of income. I show people how to do that.
Right.
And using 2/3 of what they have, would say, in a stock portfolio.
Which we have another podcast people need to go back to for sure. Okay.
Only need 2/3 of that income.
Okay.
It's protected from lawsuits, liens, and judgments. This is absolutely huge, especially for doctors, because there's so many doctors out there that are sued all the time. But it avoids probate. And I've explained this before, but I'll explain it again real shortly. If you don't have the proper plan set up, a will or a trust, and you pass away, you don't have that proper exit strategy set up, well, guess what? The government takes control of your finances. I've got a definition for probate. It's a lawsuit that's initiated by you that you're going to pay for and you're going to lose. Because just like when Prince died a couple of years ago, the entertainer, the singer, I think everybody remembers him. There's a few others, but I don't know. I'm an old guy. I remember like Joe Robbie. But with Prince, he died a couple of years ago. It's still in probate.
It's crazy.
His beneficiaries are going to lose anywhere from 75 to 85% of that estate, because they're going to have to sell the estate to pay the taxes on the estate.
Right.
Cash value life insurance is the greatest wealth transfer vehicle in the world. I've got multimillionaires that buy hundreds of millions of dollars of life insurance.
That's crazy.
They don't need the life insurance, but they need a wealth transfer vehicle so they can pay the taxes on their estate, so their beneficiaries can maintain their assets. But here's the thing too, and people don't, 6 to 12% of that estate is going to go to debt to attorneys for fees.
Mm-hmm.
That's ridiculous. That's not all. Like I said, it's the greatest wealth transfer vehicle available today. You're protected from market losses by contract because we're not tied to the stock market. It gives you the possibility of arbitraging your money in a policy loan. I know I've done this before. It's the best college funding vehicle available out there today, bar none. Now, Neil, I've got 7 policies. There's 5 are index universal life policies for myself and my wife,
right,
for long-term care or retirement. But I've also got 2 whole life policies that I use for my granddaughters. Of my son who's 100% disabled, their mother died at age 39 of pancreatic cancer, and I use that for college funding. And I do this through a mutual company because they have scholarship benefits that people don't understand and they don't know about. But here's the other thing about college funding. Let's say that you had $100,000 in a 529 plan. This college funding with cash value life insurance far exceeds a 529 plan because number one, we don't have market risk.
Right.
Let's say that you had 2008, you had $100,000 and you had twins that are going to school in 2009, but we had a 50% market loss. Now your plans have changed because people do not understand if you got a 50% market loss, it takes you 100% just to get back to even. And the market did not get back to where it was in 2008 until the fall of 2015. I can turn forever taxable money into never taxable money. I
Nice.
can give you the ability. This is absolutely huge. I can give you the ability to become your own bank, to pay yourself compound interest instead of financial institutions. When I use especially SDIC, it's a specially designed insurance contract, and you can become debt free. And it's better than the snowball effect that Dave Ramsey, professes because, Dave, what he wants to do, first off, he charges you for that. Second off, when you're done, you have to change your lifestyle, but when you're done, you have nothing. But when I'm done with my
Your lifestyle's done.
Yeah, your lifestyle's done. But what I do is I show people how to not only pay their debts off. Now it takes a couple months longer, my way, but you'll be done and you'll have hundreds of thousands in a cash value life insurance policy that you become your own bank.
That's great.
And death benefits in the hundreds of thousands of dollars that you can give to your beneficiaries or use 90% of that tax-free for long-term care.
Wow.
Not only that, it gives you liquidity, use, control of your money. And I brought this up at Harvard when I made my speech up at Harvard. I said, people need to have liquidity, use, control of your money. And I asked people, I said, would you rather have a $400,000 house completely paid for or mortgage the hill, but you have access to a financial entity such as cash value life insurance? 99% will come back, I want my house paid off. I said, well, that's great. But understand this, equity in the house, I call it debt equity. Because whether your house is paid for or not, or mortgage the hill, it appreciates the same. But what happens if you can't, you get disabled? There's more houses lost to disability than anything. And you can't pay the taxes. You can't go to the bank and get a loan.
And definitely, you can't.
No. What if you lose your job? You can't go to the bank and get a loan. You're going to lose your job. I mean, you're going to lose your house, ruin your credit. But if you have access to a financial entity that you own and control, such as cash value life insurance, maybe your plans will be delayed for a couple of years, but you don't have to lose your house. You don't have to lose your credit rating. And here's the other thing. What if 2008 happens again? It's going to happen because you had a $400,000 house. 6 months later, it's worth $300,000.
Oh, yeah.
You have no liquidity of your money. The only time that you can take control of liquidity of your money is if you sell your house. And I show people a way around that.
Mm-hmm.
It's in my opinion and the opinion of properly educated people that cash value life insurance is the best tax code approved, tax-free retirement system available today, bar none. Now I got in kind of trouble saying it's the best IRS approved, so I changed it. It's the best tax code approved, and I'm not the only one that said that. Ed Slott, the number one rated by USA Today, the number one CPA in America, the number one IRA expert in America, says the same thing. Insurance companies have the best tax-approved, tax-free retirement system available today, and I hope to have him on our podcast here the next month.
Excellent.
It's the only product that will protect your family if you live too long through the tax-free policy loans. As an example, my policy loans, when I'm 71 and my wife's 69, through these 5 policies, we'll have almost $1.5 million. And I'm just a small fish in the water. $1.5 million of death benefit that we can use for a legacy for our family, or use 90% of that for long-term care. And long-term care will affect 70% of the people in the United States, and it's very, very expensive.
So Alan, that's where you end up rewarded if you don't use that for long-term care to do lots of fun trips and everything. Stay healthy is an important thing in this process. And that,
because if you have long-term care insurance, it's like term insurance. The problem is you live up to life expectancy with term insurance as it becomes more expensive the older you get, and you can have as much money in term insurance up to life expectancy as you do in a cash value life insurance policy.
Healthy.
If you live one day past life expectancy, there's zero cash in that policy. Okay. It's the same thing with long-term care insurance. It's great to have, But if you buy it when you're 60 years old and die in your sleep at 75, all that money's gone. If you die too soon, if I died right now, my family would get a ton of money, both my kids and my wife,
Totally.
and they'll never have to worry about anything the rest of their lives. But the thing is, it protects you if you die too soon, live too long, or if you get sick through long-term care benefits.
Definitely.
And I know that for a fact because I had to go back to Nebraska. My brother, who's 5 years older than me, I had to put him in a nursing home because he has Alzheimer's. And that's one of the hardest things you'll ever do is put one into your brother, or your mother, or your
Totally.
father,
No, it's
someone you
so
love,
difficult.
into a nursing home. There were a lot of tears, a lot of yelling, and I don't want. I can't imagine people going through what I went through because it's terrible.
Oh, I feel for you.
But like I said before, it protects you from sequence returns risk. It protects you from longevity risk, which is a risk multiplier, and protects you from the number one fear in retirement, which is running out of money before you run out of life. Now, this is just a short PowerPoint presentation I wanted to share with people because they don't know. They have no idea, Neil.
It's so powerful, Alan. And then we're going to go back to Dave Ramsey. Is cash value in life insurance? That soundbite. Too bad we couldn't get him on TV when we interviewed the billionaire, as you brought up earlier. Got the opportunity. Yeah, that he said cash value in life insurance. We need to put that out as a quote on your website. So remember that. Go back to the tape, and you can quote that.
Right.
And say it was on my podcast. Congrats. Both of our podcasts, but yours for sure. So here's my question for you. And what Dave Ramsey said that tells everyone buy term and invest the difference. Why is that, just as you said, not right?
Well, like I said before, 99% of the people will buy the term, but they won't invest the difference. This will go out and blow it. But the other 1% have no idea what they're investing in. And like I said, if you invest in your 401k, because that's what they say, well, invest in your 401k. Well, that's all well and good. But fees will destroy a retirement plan. A 1% fee over a 30-year period will reduce your income by 1/3. And the average fee in a 401k, and this is by lap times back in 1999 or something like that. This is all backed up by third-party information. The average fee for a 401k is 2.99%. Now think of what that's going to do to your retirement plan. Average fee. And I have people don't even know that there are fees.
And with the market not going up for a while, and we know when the market goes up, it'd be interesting to look at those numbers. But I rather have guaranteed money. No, I'm going to keep making more money. This is a perfect deal for an entrepreneur, someone that invests in real estate, somebody who does all these different things so they don't pay taxes when they make all this money in real estate. When they make all this money in their business, they end up putting it back so they're protected. And my recommendation is you need to stay healthy. This is the best retirement push. Again, so many people are age 65 now.
Right.
Stay healthy. Like Alan, I know you work out in the gym still all the time, right? At your own gym, right? You stay out, and that's the important thing. And then have the right investment person like Alan Porter. And wow, this was extremely enlightening. And I was just blown away again and what I learned from you, it's like, wow. I have a question that I know this is a little bit off the cuff, but this is me asking that off the cuff question. You've shown us another podcast. People need to go back and watch the videos or listen to the audio version of the podcast, Strategic Wealth Strategies podcast. But one thing you brought up that's just so intriguing to me is the fact that you go with a mutual fund, which is all the push for everyone. You're going to get the same or even more rate of return going with cash value life insurance. Am I correct? And not pay
there's mutual funds. Sometimes they come back with like 20%, 30% return. That's all well and good, but understand this: the average fee for a mutual fund is over 4%. And this is by Forbes article. I've got everything's listed. And the thing is, they may be, when people say, well, I'm investing in mutual funds, I said, okay, what rating are they? Oh, they're a 5-star. I said, there's 9,500 mutual funds in the United States. They're rated by Morningstar. When you buy that mutual fund, it may be a 5-star. 6 months later, it may be a 1-star. Mutual funds are traded probably 200, 300, 400% of the time each year. And that returns that incurs another tax, short-term capital gains. So there's so many things out there that we've been indoctrinated in from Wall Street.
Right. And think about it, your own banker is the key thing.
Yeah.
I mean, everyone needs an emergency fund. I'd rather have that emergency fund making money, not 1% in a savings account, but in a cash value, and take out that cash when I need to take out that cash and never have to pay it back. It's just part of the death benefit. That's key. All these things they're not teaching, but the only man is the guru, Alan Porter. So Alan, where's the best place people can connect with you and stuff?
Well, you can always call me at 910-551-1046. And if I don't answer, just leave your name and number and I'll call you right back. Or you can go to my email. It's strategic wealth. It's up here in the corner of my photo here. Strategic wealth, the number 0@gmail.com. And you can go to my website, which is www.alanporternc.com/strategic wealth strategies. And I've got a lot of things on there. And also I've got another website. It's called Debt Free for America, that I show you how to become debt free. But guys, if nothing else, just become educated. If you don't believe me, talk to some financial planner that's educated on what I'm telling you about. But I'd really like for you to give me a call, because I think I can change your financial future.
He can. Thank you, Alan. We appreciate it. All right. That was Strategic Wealth Strategies, guys. Take care.